programs. In terms of the terms, we explain the terms exactly. We explain what the collateral requirements are. We explain what
To whom did you explain that?
It's on our website.
It's on our website.
Yeah. Okay.
So all that information is available in our commercial paper program.
And who got the money?
Hundreds and hundreds of banks. Any bank or that has access to the U.S. Federal Reserve's
You
discount.
tell us who they are.
No, because the reason.
No, I don't need to tell you who they are, right? So that's actually hilarious that they gave out huge amounts of money, okay? Huge amounts, way more than what cryptocurrencies are valued, you know? Huge amounts of money, and when they asked them, who did you give the money to? They're like, well, we're not going to tell you. So do you want to trust these people, right? Obviously not. So we agree that there are issues with the system that need to be resolved, okay? Now, yeah, let's go here to the next slide. If we are able to resolve these issues, then we can compete as cryptocurrencies with the stock market and not just the stock market, at fiat with the money markets as well. So when you're looking at what cryptocurrencies are valued at now, when this picture was taken, the cryptocurrencies were valued at 143 billion. So that's the total amount of money that all cryptocurrencies were worth. Now they're about 210 billion as of the date that I did this class. The highest that they've been was 900. But then when you compare that to other things, it's not that high. You compare that to Amazon, it's way smaller. Apple at the time of doing this video is now at $1 trillion. So it's higher than that. It's just the company Apple as of today is 5 times bigger than all cryptocurrencies together, right? And that's just one company. So then when you can imagine, you know, all companies, all stocks together, that's huge. And you know, cryptocurrencies, some cryptos are aiming to compete with some companies, right? You can have, you know, let's say a company like Uber. Well, you can have a cryptocurrency that decentralizes Uber. That basically comes out and says, you know what, there's going to be this app that you can use to get into somebody else's car as a Uber, but because there is no central company like Uber, we eliminate that. So you as a user, you pay less for your ride. The driver gets more because there's, again, no Uber. All the information is stored on the blockchain, and so everything is immutable. You cannot change anything. So if you want to give somebody 5 stars, the 5 stars cannot be changed. So it's very secure, and you would have to use a coin called something like Taxicoin or UBcoin or whatever, and that would be its own cryptocurrency. And it would make sense because people would want to use something like that because, again, less cost, faster, easier, cheaper for both persons. So makes a lot of sense, right? We could compete with that, and we can compete with that. So if that happens, then the potential to grow is huge. Now, it doesn't mean that it will happen. Maybe it doesn't work out. But from what we're seeing, we're going in the right direction. Now, we're not there yet. We haven't solved these issues yet. But that's normal. You don't want to invest in something that is already complete. As an investor, you're looking for something that is not there yet. And you're investing in it, so when it gets there, you can sell and bank the cash. Right? A lot of people want to invest in something that's already ready. But if it's already ready, it's already at its fair value. And you're not taking in the risk because there is risks involved in investing, right? You put money in something, you could lose your capital if it doesn't go the way you plan. But for everything you do, there is a risk, and you would have to weigh the risk for the potential reward. Now, the potential reward here is huge. The risk is also big because you can lose a lot of capital. But if this plays out in the way that a lot of people think it will play out, then the potential is huge. Okay. Now, looking at actual cryptocurrency prices, because then that's what a lot of other people look at, is just the price. And you can see here, we had this huge spike in price in January 2018. So that would be January 2018, where Bitcoin itself went up to $20,000. Okay, so in 2017 it was at 1,000. In the beginning, January 2017 was at 1,000, and in 1 year it went up by 20 times, right? So that's 2,000%, right? Huge. Then we had this huge crash where it dropped all the way down to 6,000, which is a 70% decrease. That would be it. 6 over, yeah. So that would be a huge drop, right? Now, if we go back on coin market cap here, and we look at the price. So CoinMarketCap is the website that most people use for cryptocurrencies, where you can see all the cryptocurrencies that are available. There's other resources that I'm going to show you later. Even for this one, we're going to go through it more in depth later on. So if I click on Bitcoin here, and I look at the price of Bitcoin, a lot of people were attracted because of this huge move. Now, a lot of people are disappointed because of this huge drop, right? But you gotta have perspective here, okay? Something that went up from $1,000 to $20,000 that did 2,000% return can drop by 70% easily. That's normal. Because now it looks like it's too big of a drop, but compared to the upside, is it really? So if I click here on log scale, which log scale, a logarithmic scale instead of a linear scale, means it removes the dollar value. It removes the dollar price and it just looks at percentages. Because here you might say, look, from 1,000 to 20,000, it's big. But you know what? From 1,000 to 20,000 is the same thing that if you went from $1 to $20. Well, where's the dollar to $20 here? You don't see it because it's so small. So if you do log, you can actually see that when we were here at 20,000 and we dropped from 20,000 to 6,000, well, that's not that huge of a drop, because look, we were here at 200 and we went to 20,000. You know, so if we go to 20,000, that's 200 times, right? So it's 20,000% return. So if something does 20,000% return and then drops by 70%, is it really that huge? Not really. But if you're looking at prices, then you might think it's very big, right? But it's not. So take that into perspective. You know, in 2013, Bitcoin was less than 100, then it went from 100 to 1,000, right? So that's a huge return. So if you look at the log scale, we are in an uptrend. There are these periods where it retracts, which is healthy for any market, right? Especially once it has a huge move up. So even when you're looking at prices, the prices are looking good, right? The trend is upwards. Yes, there are pullbacks, huge pullbacks. But when you're looking at it from a longer term perspective, it's not actually that huge. You know, somebody who put in money, you know, anytime before, even somebody who put in money last year, they're up. You know, everybody literally is up. The only people who are down are people who bought at the highest high in January. Well, that might not be the case in a year if the prices go back up above that price. So there are a lot of problems that need to be solved. And because we have a lot of smart people working on a lot of cryptocurrencies, which we'll talk about, trying to solve these issues. And by solving these issues, the value of these currencies will grow. There is potential for us as investors finding the right currencies, investing in them, creating a portfolio that could be either passive or active, and participating in that growth and doing that in the right way. So that's why you'd want to invest in cryptocurrencies. So I hope you're psyched about this as much as I am, because I put a lot of sense in cryptocurrencies every here and there, because I see huge potential in this industry. And in the next lectures, we'll be talking about little things that will help us invest better.